So as promised, I'm going to make this video to explain the trades I took and why I took them. Before I start, I want to give a disclaimer. I'm sure that not everybody on this group would really understand this video because not everybody on the group knows ICT terms, and I'm going to be using ICT terms on this video. So if you watch the video and I see something that you're not familiar with, if you have any questions you can ask. I'll be available to answer questions. So back to the trade. So this is Nasdaq, and this is the trade we took. No, this is the trade idea that we were supposed to work with. So we're supposed to take a buy here and then take profits around here, right? So two reasons why it did not play out as expected. First, like I said, today is Friday. Excuse me. Today is Friday, and usually, because of the weekly range, what the market usually does on Fridays or weekends is that it tries to complete the weekly range. You know how candles form? Candles, okay, if this is the weekly candle, let's say it was bullish throughout the week, the candle goes up, indicating that bullishness, and then when it's about to close, it comes down and then closes with a wick. So it closes and leaves a wick above here, right? So usually, even if we're bullish, even if we're still bullish, for the weekly range to close, it cannot close with full body like this, so it has to leave a wick. So when I said that I am mindful of the fact that today is Friday, this was what I meant. So yes, we know that we are bullish. Excuse me. Yes, we know that we are bullish, but we might see a situation where the bullishness pauses, not stops. It doesn't stop, it just pauses, and then the market closes with a wick. So if we scale out to the weekly time frame, let me even go there, you'd see exactly what I'm talking about. So let's say, so this week had been bullish, it's even closing as a doji, right? So that's what I'm saying. So it went up all the way to the here, and then closing today closed here, I see, and then left this week. So that's what I was mindful of. So back to the reason why I took the trades I took. The trade idea was framed on the 4-hour time frame. So if you go to the 4-hour time frame, which is here, this is the 4-hour time frame. This is the trade idea. So for me, my entries are always based on PD arrays. Like I said, I'll be using ICT terms. PD array is an ICT term, and it simply means premium discount array. So what a premium discount array is it's just a generic term for things like order blocks, fair value gaps, and the likes. So if you're not familiar with order blocks, you can do a Google search. Just go to YouTube, learn about order blocks. So all or most of my trade executions are usually based on higher time frame PD arrays. It could be an order block, it could be a fair value gap, it could be anything, but they are usually based on something, based on PD arrays especially. Okay, so for this particular one, it was based on this order block, this series of order blocks. So when order blocks are in series, like they appear consecutively like this, I use all of them as my order block. Okay, so this is not a tutorial to teach order blocks, so I'll just assume that you understand why I marked this entire region. That's this entire 1, 2, 3. Why I mark them out as my order block. I'll just assume that you already understand that. So I'm essentially going to teach my model how I frame trade entries. So every time I see an order block like this, and price I hold a bias in the market. I've been bullish since last week, and I'm still bullish. Price took out this sell side liquidity and then shifted structure. So I expect it to go up and take out this high here, right? So it retraced into another block, this other block, right? And when I see a PD array on a particular time frame, I have what I call time frame alignment, where once I see a PD array on one time frame, I know the next time frame to go and look for the structure, to do structural analysis. Okay, so if I see a PDRA on 4 hours, I immediately go to 15 minutes. So now there were two things I wanted to see on the 15 minutes time frame. The first thing I wanted to see was price. Now this is a Fibonacci retracement tool. I use it to mark premium discounts just to know the equilibrium of my dealing range. Excuse me. So this is the origin of my dealing range. This is the terminus or the end of my dealing range. So I'm working with this dealing range from here to here, right? And I want to see this box, this rectangle indicates that other block I mentioned or I pointed out on the 4 hour time frame. So this other block is a 4 hour order block, and I wanted to see price come into it on the 15 minutes time frame. Now I wanted, like I said, I wanted to see two things. First thing I want to see the market dip into this order block. And then on dipping into this order block, I want to see a liquidity pool created and then taken out, which happened here. A liquidity pool was created here, this marked out, which is marked out by this rectangle, this line. So let me call it sell side liquidity. So sell side liquidity was created, SSL means sell side liquidity. Sell side liquidity was created on this tap of the order block, and then the market ran it out here. This is a stop run. This was the leg that took us out, and I'll explain why this happened. Okay, I'll explain that in a bit. So this was what I wanted to see. I wanted to see an SSL created and then taken out, and then this is liquidity sweep. After liquidity sweep happens, the next thing I want to see is expansion, and that was why I was saying that if the price closes above a certain area, I wanted to see it expand. Okay, but now the mistake I made on the first trade is that I chose this very shallow tap on the order block. I chose it as my first tap, which is my liquidity pool, which was wrong, because it is better, or it is preferred to see this liquidity pool inside the order block. Okay, it's preferred to see it inside like this. This is the proper liquidity pool, and then this is the stop run, and now the price is supposed to now take us to here. So on Monday we're going to trade the London session, because already liquidity has been run, so there's nothing in the market, there's no reason for the market to come down again. There's absolutely no reason. So what I expect on Monday is to see a lower time frame stop run, and then an aggressive pull to this target. Okay, so the only mistake we made, or I made, was recognizing this as my liquidity pool instead of this. So that was why I said, after this stop run happened and I recognized that I'd made a mistake, I said I was going back in. I went back in. Actually, I took the trade from here all the way to here. Okay, so this was the whole trade idea, and this was why I took the trade. All right, so this is my model. Essentially, I wait for stop runs, and then I take the entry and I target the opposing side of liquidity. So this is the sell side liquidity. This would be the buy side liquidity. Notice I'm using the bodies, because there's a saying that the bodies tell the story, the wicks do the damage. So if you want to know where price is actually going, use the bodies of candlesticks. You look for body closures, not just wicks. So this is my target for next week. I'm going to trade the London session. I hope I am active on WhatsApp, so I can just leave the signal. I think this will be all. I hope I have explained the reason for this trade and what I expect for next week. Let me mark it out so everybody knows exactly what I want to see. So the market has already taken out liquidity here, so I just want to see maybe a small, very shallow retracement, and then an aggressive run to this buy side. So that will be all for this particular lesson. Thanks for watching.